I want to talk about something that can shape your financial future in the most profound way: investing. But here's the catch: you don't need a ton of money to start. In fact, even if you only have $50, you can begin building wealth now in your 20s that will pay off exponentially over time. Investing isn't reserved for the wealthy. It's about making small, smart choices today that can lead to financial freedom tomorrow. Let's dive into how you can start investing, no matter how small your budget might seem. Understanding the power of compound interest, 2000 words. Before we dive into how to start investing, let's talk about one of the most powerful concepts in personal finance: compound interest. Compound interest is what makes investing so magical. It's the process where you earn interest not just on your initial investment, but also on the interest that accumulates over time. This snowball effect means that the earlier you start, the more time your money has to grow. Imagine you invest just $50 today in an account that earns 7% annually. Over time, that $50 will grow, and as you continue to add to it, the returns will start multiplying. The beauty is, you're not just earning money on your $50, you're earning money on your earnings. This is how small investments can turn into big financial rewards in the future. Starting in your 20s gives you the advantage of time. Even if you start with a modest amount, compound interest allows your investments to grow exponentially the longer you keep them in the market. 2. The basics of investing, 300 words. All right, let's break down the basics of investing. What is investing? Investing is essentially putting your money into something with the expectation that it will grow over time. You can invest in stocks, bonds, mutual funds, real estate, or even cryptocurrencies. But the idea is to pick assets that will increase in value. Why invest in your... Many people in their 20s overlook investing, thinking it's something for later in life. But the truth is, the earlier you start, the more time your money has to grow. As a young adult, you have time on your side, and investing now means that you can take advantage of long-term growth. What are your options? Stocks. When you buy stock, you own a piece of a company. Stocks tend to have higher potential for growth, but come with higher risk. Bonds. Bonds are loans you make to companies or governments. They pay interest over time, but tend to be safer than stocks. Index funds and ETFs. These are a collection of various stocks or bonds which help spread out risk. They're considered a safer option for beginners. Real estate. Although it requires a bigger initial investment, you can invest in real estate through REITs, real estate investment trusts, for as little as... Cryptocurrency, a more speculative and volatile investment, but with enormous growth potential. How do you choose? Start by doing research. You don't need to be a finance expert to get started. Websites, apps, and even financial advisors can help you understand your options. Then you're getting started with just $50. So you've got $50. It might not seem like a lot, but it's a fantastic starting point. Here's how you can start investing with that amount. Step 1. Open a brokerage account. To begin investing, you'll need to open a brokerage account. Thanks to technology, there are plenty of online brokers that allow you to start with a small amount of money. Some even let you open an account with no minimum deposit. Popular platforms like Robinhood, Wealthfront, Acorns, and Fidelity offer low or no fee accounts that let you invest with as little as $1. Some even let you invest in fractional shares, meaning you can buy portions of stocks rather than the whole share. Step 2, choose low-cost investments. Once your account is set up, focus on low-cost investments like index funds or ETFs. These are ideal for beginners because they diversify your portfolio automatically. Instead of investing in just one company, an index fund or ETF spreads your $50 across hundreds or even thousands of stocks or bonds. Step 3, automate your investments. To stay on track, consider automating your investments. Many platforms allow you to set up recurring deposits, even as low as $5 per month. Over time, these contributions will add up, and you'll be on your way to building a sizable investment portfolio. Step 4, reinvest your earnings. As you earn dividends or interest, reinvest those returns back into your portfolio. This is where compound interest works its magic. The more you reinvest, the faster your wealth will grow. 4 common mistakes to avoid, 2000 words. Even with just $50, there are mistakes you should be aware of as a new investor. Trying to time the market. It's tempting to try and buy low and sell high, but the truth is, no one can predict the market consistently. Instead, focus on long-term investing. Focusing too much on individual stocks. Individual stocks can be risky, especially when you're just starting. Diversifying through index funds or ETFs is a safer bet. Letting emotions drive decisions, the stock market goes up and down, but emotional reactions like panic selling during a market dip can lead to poor decisions. Stay calm and stick to your long-term plan. Ignoring fees. Pay attention to fees. High management fees or transaction fees can eat into your returns. Look for low-fee investment options. 5. The role of risk in investing. Risk is an inherent part of investing. The higher the potential for return, the higher the risk. However, if you start investing in your 20s, you have a lot of time to recover from any potential losses. In your 20s, you're likely in the ideal position to take on a bit more risk because you don't need access to your money for many years. This means you can afford to ride out market fluctuations without the pressure of needing the money right away. Here's how to think about risk. Risk tolerance. This is your ability to withstand the ups and downs of the market. Everyone has a different tolerance. Some people are comfortable with high-risk investments like stocks, while others prefer low-risk steady returns like bonds. Diversification. One of the best ways to manage risk is by diversifying your portfolio. By spreading your investments across different asset classes, stocks, bonds, real estate, you reduce the chance of losing everything if one investment doesn't perform well. Long-term perspective. As a young investor, time is your biggest ally. Even if the market dips in the short term, staying invested long-term usually leads to positive returns. 6. Keep learning and stay consistent. 150 words. Investing isn't something you learn overnight, but the more you educate yourself, the better you'll become at managing your money. Take advantage of free resources, books, podcasts, blogs, and YouTube channels. Follow financial influencers and experts who provide valuable insights. Also remember that consistency is key. Whether you're investing $50 or $500, don't expect to get rich overnight. Building wealth takes time, patience, and discipline. If you stick to a consistent investing strategy and make decisions based on knowledge, you'll be amazed at how your money can grow. Conclusion. 150 words. To wrap up, starting to invest in your 20s, even with just $50, is one of the best decisions you can make for your financial future. It's not about how much you start with, but about the consistency, strategy, and patience you apply along the way. The sooner you start, the more time your money has to compound and the more wealth you'll build for yourself in the long run. Remember, you don't need to know everything about investing to get started, but you do need to take action. Open a brokerage account, start small, keep learning, and stay consistent. In the end, it's not about how much you invest now, it's about creating the habit of investing that will set you up for financial freedom in the future. Thank you. The earlier you start investing, the more time you give your money to grow. And this is one of the most powerful reasons to begin in your 20s. When you invest, your money doesn't just sit there. It begins to earn returns. And here's where the magic happens. Those returns themselves earn returns. This is called compound interest, and it's one of the key factors that make investing so powerful over time. Let's break this down. Imagine you invest $50 in a low-cost diversified investment that grows at an average annual rate of 7%. At first, your $50 doesn't seem like much, but over time, you'll start earning returns on that initial amount, and then those returns begin to grow as well. The more time you give your investments, the more this effect snowballs. In 20, 30, or 40 years, your $50 could grow into a significantly larger sum thanks to the cumulative effect of compound interest. The beauty of starting in your 20s is that you have decades of compounding ahead of you. Even if you only invest small amounts at first, the fact that your money will be growing steadily over time gives you a huge advantage. The sooner you start, the more you benefit from the time factor because compounding takes time. The earlier you start, the less you need to invest monthly to reach your financial goals, making it easier to build wealth. In essence, investing in your 20s is about giving your money time to work for you. With a modest amount like $50, you may not see huge returns right away, but in the long run, that small investment can grow into something much bigger with time and consistency. Starting early is the key to unlocking the power of compounding. When you're just starting out with investing, you don't need to be an expert in the stock market or spend hours analyzing individual companies. Instead, a smart strategy is to invest in low-cost, diversified options that allow you to spread your risk while still benefiting from long-term growth. One of the most accessible and beginner-friendly options are index funds and exchange-traded funds. Both index funds and ETFs are designed to track a specific market index, like the S&P 500, which includes a wide range of large companies. By investing in these funds, you're automatically buying a small piece of each company in that index, which means you're spreading your risk. If one company's stock drops, the others in the index might still perform well, helping to balance out potential losses. This is crucial for managing risk, especially when you're new to investing. The real advantage of these funds is their low cost. Rather than paying high fees for a fund manager to actively pick and choose stocks, these passive investment options have much lower management fees, allowing you to keep more of your returns. Over time, the difference between high fee and low fee investments can add up significantly, especially when compounded over decades. Even with just $50 to start, you can gain access to a broad array of stocks, bonds, or even real estate through real estate investment trusts, REITs, all without needing to pick individual stocks or time the market. This kind of diversification reduces your risk and allows you to invest in a wide range of assets, all for a relatively small cost. So while you may not be able to invest in dozens of individual companies, index funds and ETFs let you diversify in a simple, cost-effective way that grows with you over time. Investing is not about making quick money or following the latest trends. It's a long-term game where patience and consistency play crucial roles. One of the most important factors in building wealth through investing is simply showing up month after month and continuing to invest, even in small amounts. Starting with $50 may seem like a small step, but if you make it a habit and stay consistent, you'll begin to see the benefits of your efforts over time. Even if you can't contribute a lot right now, it's better to invest small amounts regularly than to wait until you can invest a larger sum. By consistently adding to your portfolio, even in small amounts, you take advantage of compound growth. The more you contribute, the faster your investments will grow. Staying consistent also means not being swayed by short-term market fluctuations. Stock prices will go up and down, and the temptation to sell or change strategies during a downturn can be strong. However, successful investors know that market volatility is normal. They focus on the long-term horizon and stay committed to their investing strategy. Regular contributions, along with a steady long-term approach, will outperform quick emotional decisions made in response to market movements. In addition to consistency, continuous learning is essential to becoming a more effective investor. The world of investing is vast, and there's always more to learn. By taking time to educate yourself about different investment options, strategies, and market trends, you'll be better equipped to make informed decisions. Whether it's reading books, listening to podcasts, or following financial experts, expanding your knowledge helps you stay on top of your investments and improves your ability to navigate the complexities of the market. As you grow as an investor, your confidence will increase, and so will your ability to build a stronger financial future. Starting with $50 today, coupled with consistent investing and learning, can set you on a path to financial independence that may seem distant now, but will become more achievable with time.